All right, Greg, we are live. If we wait just a minute or two here, it'll let people know that the stream is on. Um, how's your week going?
It's good. It's good. Just grinding through another week. At least we've left the boredom phase of futures for the time being. So it's markets move around. It's a lot more fun than watching something kind of sit and trade sideways.
Yeah, we were down in Omaha at the Building Component Manufacturers Conference and the National Framers Conference, the Framers Summit. Uh, Boy, I tell you what, we picked up a lot of great information down there. Some some really innovative thinkers as far as machinery and ways to build. Um, it's pretty cool. One of the big takeaways I have from that is they all know where the new source of lumber is, or the growing source, I should say, southern yellow pine.
Yeah, yeah.
It, I heard of things that I'd never heard before, where they're using um, spruce or Doug fir, hem fir studs, and southern pine for the plate stock.
Yeah, yeah.
Which
Yeah, I've got a customer in the Omaha, Nebraska area, and I got to tour his truss plant. This is probably two years ago in the fall, and just watching him put stuff together. He had three species going into a truss where, yeah, this is the cheap, like where 5 years ago, 10 years ago, you were, wholly relying on one species, and now it's just more a function of price.
oh yeah, for sure. Um, all right, so I think we got enough. We've given people plenty of time. Um, so everybody, welcome. This is going to be the show that we do every Tuesday at noon. I apologize for being a little late today. This is one of my first streams, so I was still getting all my ducks in a row. But I'm going to welcome Greg Kuta from Westline Capital Management. Greg, I've known for a long time. The thing I can say about Greg is you will not find a man with more integrity than Greg in the lumber futures industry, and that's what you're looking for when you're dealing with someone in the lumber futures, someone full of integrity. So, welcome, Greg.
Thanks, Mike. I appreciate being here, and very kind words. And I've known you a long time as well, and I appreciate the opportunity. I think you guys are doing good work, and likewise, I think you and Ashley and the gang, what you see is what you get, and it's really good stuff.
All right, well, Greg, we got a big job on our hands here, and I'm going to tell you how I know this is 2 weeks ago. I was at a conference for that Random Lengths put out. Excellent conference, by the way. A lot of great data and information there. They had a panel that was talking about lumber futures, and one of the panelists said on there, it takes someone with an above average IQ to understand lumber futures. And that really struck me. And it struck me as number one, wrong. But this perception that lumber futures is difficult and confusing, when the lumber futures you and I know is actually fairly simple. It comes down to mathematics. Now the analysis of it, you can get a lot deeper on, but at its core, it's simply price discovery and math. And that's what we're going to talk about today, which the topic we have here today is fantastic. We're going to talk about basis, which is the difference. That's another thing. We speak in some crazy terms that mean one thing for someone and another thing for another person. But when we say basis, we're simply saying the difference between the price that the futures contract is trading at and the price that someone is able to purchase or sell at in the cash or spot market.
Yeah, correct. No, I think it's as simple as cash minus futures. It's a simple equation, just cash minus futures. And you can look at cash of any species. It doesn't necessarily have to be Western SPF. It can be Eastern SPF. It can be hem fir, Doug fir. It can be 4-inch. It could be 6-inch. It could be narrows. It could be wides. It could be MSR. Run the full gamut of whatever you want to look at from a physical cash standpoint, and you're just doing a comparison, a real day comparison versus an historical relationship between that cash item you want to look at in the futures market.
Yep, simply as that. So let's show the math on it. If you can go to the next slide, Nick, that'd be great. Oh, the next one.
Yeah, there you go.
All right. So this is what we're talking about. Basis. It, by the way, it can be positive or negative, but what you have here, cash price minus futures price. So why don't you walk through this example and talk about why you came up with negative 162?
Yeah, so again, it's always going to be the cash market minus the futures market. And so what this is telling us is that, and this is from about 2.5 weeks ago. At that time, Western SPF 2x4 number 2 and better was $472 on random length print. At that time, November futures was $634. You do the basic math, and cash is trading at $162 discount. Futures is trading at $162 premium to physical cash. So it's that simple. You're just taking the print for random lengths or what you perceive to be physical cash on whatever item you're looking at, and then you're comparing it against one of the months in futures in the futures market. Typically we'll use the front month as a comparison, a reference point. So the idea, basis is strengthening, basis is weakening. I think there are a lot of preconceived misnotions when it comes to basis, as far as one side, okay, the cash side, the futures side, one side has to do something. We have these preconceived notions that, well, if cash is undervalued to futures, I think futures has to come off and collapse into cash, or I think cash has to rally and converge with futures. And the answer is, from a purely basis standpoint, you're not trying to speculate on the direction of the market. You're just trying to capture an anomaly in the basis and look for that historical convergence. So in this case, you've got this $162 basis. You're looking, a pure basis trade is looking for the convergence between cash and futures. So that means either futures can come down, cash can come up, or somewhere in between lies the truth, and both converge on each other. But saying that I only want one side of the basis trade to happen, that's speculation. And that's okay, but the idea is you're just looking for that convergence of basis.
Now you threw out another big word, convergence. So what is convergence? Why does it happen? How does it happen? So let's just say what it is. It simply is the two prices moving towards each other. And theoretically, the way futures should work, especially on a deliverable contract, is at some point as you approach the expiration or the final trading day of that contract, the price of futures should match the price of what the spot or cash market is.
Yeah, and I would say you're never, in an ideal world, you're going to get perfect convergence. Anything that converges within $20 to $40 is considered a victory from a convergence standpoint. And, that convergence, again, this is a deliverable contract. The idea that spot month futures, so November futures on November 15th expiration day, should be trading within a certain, again, even money within $20 to $40 of where the physical cash market is. So the idea is that futures is just that. It's a perception of what we think pricing will be off in that distance. When you look at the futures price curve, you've got November, you've got January, you've got March. The expectation is the further out you go from today, prices are going to be substantially higher based upon futures pricing today relative to physical cash. Come November 15th, if November is truly meant to be at $775, then physical cash, let's say physical cash today is somewhere in the 590 to 610 area, then as you get closer, as you grind through October into the back half of October, as you get into the spot month, November, then that convergence, that move toward each other should happen And statistically speaking, that's not my opinion. When you look at the history of lumber, convergence always takes place as you get into expiration, as you get into that spot month, where this is a deliverable contract. One is going to relate to the other as you get into expiration.
So let's talk about that. Why does it happen? So today, but let's just say where we're at today. It is October 12th. Okay. We've got about a month till expiration. Okay. I can sit here and say, well, lumber futures is wrong. I'm not paying that. I'm buying in the cash market cheaper. So lumber futures is wrong. That's not a true statement, because the futures price is just the price. It's where things are trading. Here, you know what? Let me share a screen here. And I'm sorry, I'm going to share a window. No, I'm not going to share a window. I'll share a screen. Better idea. Let me make this bigger. So Nick, could you turn that screen on? This is live lumber futures as it's trading exactly. So November has a 765 bid, 772 offer. If you want to buy futures right now, you would pay 772.90. If you want to sell it, you'd sell it at 765. That's fact. You cannot argue that. But this is a railroad car of lumber that is going to ship from the mill sometime in the time period between November 15th and December 1st, approximately.
Yeah, I mean, realistically, what you're looking at is either the 4th week of November or 1st week of December delivery of that rail car of lumber. So November futures right now, from a buyer's perspective, is wood that would hit your yard the end of November, beginning of December.
Okay, if I went to a large mill today and said, I want to buy a rail car of 2x4 that has the same exact tally as specified by the lumber futures contract, what am I going to pay?
I mean, depending on what mill's on the market today, realistically, you're probably somewhere in that 600 to 620 area, FOB mill, Western SPF 2x4 equivalent.
Okay. So if I'm a sawmill and I know that if I go to the market today, I'm selling it at $620. And I know that if I have wood that I can ship in November, I can sell it at $765. Correct?
Yeah. No, and that's not an opinion. That's fact.
So let me just say that again. If I want to sell wood today, what price can I sell it at? 600 to 620.
Yeah.
600 to 620. 600 to 620. Fact. That's what it is. If I want to sell wood between November 15th and December 1st, I'm going to sell it at, I can go to the futures contract, make a delivery, and sell it at 765 to 772, somewhere in there. Those are facts.
Those are facts.
So why does convergence work? Because as we move towards November 15th, those two scenarios end up being the same scenario. I can actually sell it to someone who's on the phone calling up my mill, or I can sell it through the CME. They become the same thing. That's when convergence happens, right?
Yep.
Now, vice versa, in this case, as a buyer, why would you pay more today for that product on the futures contract than you could buy in the cash market? You wouldn't do it, right?
One would think.
So the concept of convergence is we describe two separate actions when you're 30 days away from what the delivery period is for futures. That is a different conversation than buying wood today. They are different, totally different animals, if you would. But over these next 30 days, that those two business processes are going to cross over and become the same. And that is when you'll have convergence, because I would venture to guess the stakeholders at a sawmill would be really upset with the sales department if they were selling wood $160 less than what they could be selling it for in the futures contract.
And I couldn't agree more on that. Yet that's what you see today, where mills are happy to build out their order file. There are sawmills right now, the week of 11/1, the week of 11/8, that have sold 550 to 575, 580, maybe 600, when that same wood deliverable into the board could be capturing $150 to $160 premium. And there are sawmills that are actively selling November today, where the wood that they're selling is that order file for the week of 11/1, the week of 11/8, the week of 11/15, the week of 11/22. So you know, it defies. You know, you're trying to apply logic to something seemingly so illogical, where to those that understand it, it's perfectly logical, and you have that execution. And I'm looking at the commentary, and you know, Ashley references that's almost $17,000 profit per car. That's fact. You know, the sawmill that's selling the board today at 770 plus, 780 plus, 760 plus, 750 plus, from a shareholder value standpoint, you're capturing $17,000 more per car in profit than your competition. That's fact.
I know that there's some people at a sawmill right now that are just rising out of their chairs upset, saying he doesn't know what the hell he's talking about. And I would like to comment on that, because there is some truth to what they're saying. A sawmill only has so much capacity to store product. A sawmill is not going to store 2 months worth of their production on their property. And what's important to note is in the rules for the CME group, if you have a rail servicing your sawmill, the only way you can make delivery is loading a rail car at your sawmill. That is fact as well. You can't just put it into some offsite warehouse and ship it out of there. So what I think we need to understand is putting ourselves in the sawmill's shoes. They would, trust me, they would love to sell 500 cars at this price if they had the capacity to warehouse 500 cars. Think about this. Like Ash said, you can pick up $17,000 per car in the next 30 days. If you have a sawmill that's making 100 cars a week, or no, I mean, I don't know however much a big sawmill would make. First off, they can't run that much 2x4, probably.
Sure.
But I think we have to understand there are constraints at how much delivery our entire sawmilling capacity in Western British Columbia, which is where the delivery point is, how much capacity they have to actually put into the futures.
Sure, and again, I don't disagree with that, but set aside a percent of your overall production on 4-inch, on 6-inch. You know, again, it actually references the idea of EFPing, and that's something sawmills can move the wood into a reload and EFP that wood. They don't have to stand there for delivery. And then the other misconception is that you need this perfect convergence, where at $150, $160, do you need to capture all $160 of that? Is $100 good enough? Is $80 good enough? Let's say by the time that you get into the end of October or first week of November, and there's not a captive EFP market, then you unwind the futures and you sell the physical cash in your traditional, the way you would traditionally sell your physical cash, where to get the 100% convergence, to capture 100% of this basis, then in theory, you need to sit there and make or take delivery to do that. But that's not the idea, is that when you have a basis this wide, as you get closer to the spot month, as you get closer to expiration, you can capture a percent of the basis and still be highly profitable. You could still use this as a profitable tool. You don't necessarily need to capture 100 cents on the dollar, 80 cents on the dollar, 70 cents on the dollar. Adds value relative to your competition that's not doing this.
Yep, no doubt. Okay, look, we've beaten this horse to death.
Yeah.
What I'd like to do is let's go back to your slide deck and let's talk about the opportunity and where the opportunity lies, right? So I think we can stop here. Let's go to the November basis. I think it's the chart before. From a historical standpoint, there's never been a better time to buy lumber, store it, and sell futures.
No, and what you're looking at here, Mike, is the green bar that says negative 170. That's assuming cash today is $600, and you're just taking, again, that basis, the cash minus futures, where cash is trading negative $170 under the November contract. If you look at the far right where it says that 5-year average, historically speaking right now, and this goes back 7 years, 10 years, 15 years, 20 years, the average basis, the average relationship between November futures and physical cash, again, this is physical cash, Western SPF 2x4s, futures should be trading at a discount to physical cash right now. Historically speaking, we should be at a discount to cash. And yet, you from historically where you should be trading, you're almost $200. You're $190 away from the historical average of what you year after year after year have traded at.
Yeah, and let's take a look at the January one. It's 200. That's amazing. Now, it hasn't always been this way. Let's roll to the next chart. This was just a little over a year ago in that massive run where cash had gotten so far out in front of futures. What do you have to make of this chart?
Well, I mean, this is your ultimate example of this is last September. So this is September of 2020. When September expired, you know, at that point, we were at a historical high of about $1,000. The next contract, the November contract, was basically trading $300 under the September contract. So you had September expired at $1,000. You had November at $700. You had a differential between the front 2 months of plus $300. So this is your ultimate example of people couldn't satiate themselves. They couldn't find enough of the physical wood. So everybody, this premium that September went off, everybody needed prompt wood. Everybody needed immediate wood. So September, in lieu of cash, became a viable source to physically take delivery of the September contract because they couldn't find the physical cash. So this is your ultimate example of a bull market structure on steroids here.
Yeah, I like my analogy for this is called stadium beer.
Yeah.
Why do you pay $10 for a cup of beer in the stadium while you're watching your football game or, you know, baseball game, when you know that in 4 hours later, you could be sitting in your chair at home watching the replay of the game with a 50-cent can of beer? It's because in the moment you needed the product and you knew that in the future, yeah, you were going to use the product, but your need and your desire to pay up for it was going down.
Yeah, and again, you know, the perfect example of this is that, so, and again, I don't have the slide in here, I should have added it, but, you know, like right now we have the November Jan as the front month spread that exists today, where you have November minus January. So if you look at November versus January 2020, so this spread expires at 300 over. That Nov-Jan spread, as the market corrected into October of 2020, that Nov-Jan spread went from 150, 170 over. It actually traded at a discount, where at one point November traded 20 under January, where you had the reversion back to, you went from a bull market back to a normal market structure, even a bear market structure within one contract. So the next slide here references September, the spread structure in September of 2021, and what a difference a year makes. So in 2020, we went from 300 over. In 2021, September expired 140 under. And there are some caveats as to why, but this is your ultimate example of a bear market structure, where you've never had a spread go off at 140 under. So you had two extremes back-to-back years, where you had the most extreme example of a bull market structure, and then you had the most extreme example, this just, you know, a September expiration of September trading 140 under November, where nobody wanted the prompt wood. There was the perception that there's all this prompt wood out there. I don't need wood now. I'm still fighting the last battle. I'm not worried about my needs today. I'm more worried about end of Q4, Q1 type wood.
Yep, absolutely. One of the things that I took away from this conference that we just went to, where we were talking to framers and component manufacturers who are locking in business for extended shipment. So I think as our world becomes more transparent and we start to understand who are the true users of the product, which is lumber, the true user is going to be the developer, right? That developer is doing a project. They want to secure their prices. They are, doing all the organization around getting that project set up 12 to 18 months ahead of time. And they make assumptions based off of what they think lumber prices are going to do. In this last market move, we blew through any and all long-term assumptions, right? And I think we forced into the market people that had no business, that didn't plan on making their purchases at that time, and then just needed to buy to protect whatever margin they had in their project in that business, right? That is causing volatility in this market for sure, which I want to cover next week. But I think it's important to understand the ultimate buyer of that project and how they're becoming more influential in purchasing decisions in the spot market.
Yeah, Mike, and the other thing I want to say is I'm not trying to admonish, making blanket statements that everybody can do this. That I understand that everybody is uniquely different, and certain sawmills don't necessarily produce 4-inch; they produce studs, or they produce heavy MSR. These correlations, these basic examples exist for every species, every item that's out there, and the one thing that I can't stress enough is you cannot have a blanket approach when it comes to risk management. You have to look at your own setup. What do you produce? What do you consume? How do you consume it? What's your customer base? And all these different variables are critical in developing a risk management strategy, whether you're going to implement a basis strategy, a forward buy strategy, a production hedge strategy. You cannot assume the industry's risk is your own. You have to look at yourself. What are your wants? What are your desires? Where is your risk? And then therein lies the actual implementation of a unique program for you. And again, whether it's with me, it's somebody else, you cannot, the blanket approach of, well, every sawmill should be doing that. I understand that not every sawmill can be doing this, but the ones that can do it should be doing it. And that's where you truly need to look at your own operation to understand that. And I know we're up against a time crunch, but if you go back one slide, I just wanted that November basis chart again. All this tells us,
there you go. Yep.
Yeah, right there. All this tells us is that when you look at futures versus physical cash is the buy opportunity, futures is the sell opportunity. I would not advise anybody to be buying a premium, a $200 premium to cash. If you need to own, and typically you do forward buying in the back months of futures, you're better off buying the cash, paying the cost to carry, and then either buying a put or selling futures against the physical cash position from a protection standpoint. But that's all basis is trying to tell us what's overvalued, what's undervalued, and how can I benefit from, either futures or cash.
Perfect. I'm so glad you brought up strategy. We got enough time. I want to go over this because I think this is super important. This market is set up for basically one trade, which is buy the wood and then sell the futures and wait. And you wait for that convergence. What are some of the landmines, some of the things that could happen in there that if you decide to take on that strategy, that you'd have to just kind of know and be looking for?
And I think that's so again, when people take on these strategies, do they have a preconceived notion of, I'm doing this strategy because I think futures should collapse into cash, or I think cash has to explode up into futures? So if I'm doing this with the expectation that futures has to collapse down into cash, okay, November has gone from $630 last Thursday up to $790 today. You've had a sizable run in futures relative to a very small run in physical cash. Cash has seen the appreciation, but nowhere near the extent of what futures has gone through the last 3 to 4 days. So one of the landmines is margin calls. Okay,
Yeah.
for this convergence to take place, you have to have the patience. You have to have the ability to put the wood on the ground and then not sell that wood and wait for the convergence to take place. And in the middle of that
Hang on a second,
convergence,
Greg.
yep.
Hang on a second. You threw out margin call.
Yeah.
What is a margin call?
So when you trade the physical cash market, you have 100% cash outlay. You buy something from a sawmill or a broker, lock, stock, and barrel, you own it. You write the check for 100% value of that physical cash. It's yours. You have that 100% cash outlay to the other individual. With futures, you're just putting up a percent of the underlying contract value. It's called a performance bond. And this is something that's regulated by the Chicago Mercantile Exchange, the CFTC. So when you trade futures, there's not 100% cash outlay. You're basically putting up a performance bond or a margin on a percent of that underlying contract value. So as the market moves against you, every single day, that contract is marked to market, meaning whatever that price change is on any given day in lumber futures, that credit or debit is going to go into your account. The credit's going to go into your account. The debit's going to come out of your account. So as the market moves higher, and as the market, I sell November at 6:30, the market goes to 7:30. I have to margin that difference in the price above and beyond my initial margin that I put up, or that initial performance margin that I put up. I have to margin based upon that market to market move at any given day.
All right. I'm going to play interpreter here and tell them exactly what happens. So the margin on one futures contract is around $5,000 today, correct? I think.
We're about 7,000, depending on if you're a spec or a hedger, you're somewhere around 72 to 7,800.
So let's call it $7,000. Your account can never have less than $7,000 in it if you have one futures contract on. So if the market moves and your account loses $10,000, you have to put in. So you had 7,000 in the account, you just lost 10,000. Now you're at negative 3,000. You need to put $10,000 into your account. You literally have to write a check, send money to get your account back to at least $7,000. Now the reverse can happen as well. If you make $10,000, that goes into your account. You actually can remove it down to that $7,000 mark. But at a minimum, at the end of every night, your account has to have a minimum of a $7,000 balance in it. So when Greg said margin, what he meant was money. You have to put money into your account to make sure it always stays at $7,000. So in the example of what has just happened, and I know people that are in basis trades right now that are continually having to fund their futures account. Now, the cash is also increased in value, but the convergence hasn't quite happened yet. So one of the landmines is you have to be liquid enough to fund your account to appease the CFTC and the CME.
Yeah, no, I think that's a great point. And if anybody wants further information, I've got a lot of basic examples, a lot of intuitive slides that kind of help explain this at the ground level, what margining is and how futures work from a cash outlay standpoint. And the other thing, like the landmine, again, this all goes back to what so one of my big things that I stress to people is that when you put a trade on, it doesn't matter if it's speculative or risk management, write down, why are you doing this trade at this given point in time? This is what I'm trying to accomplish. This is my risk to reward. And then as you float through that trade, what's changed? And from a basis standpoint, if you have the margin wherewithal, if you have the ability to finance this, the convergence will still take place. But if the idea was that I want to do this basis trade, but I only want to do it until the wood rolls at me and I have to move off that wood. I'm not going to put it on the ground and see this to fruition. That's speculation. And again, that's fine. But when you do that trade, what are some of the landmines that you potentially see when you do it? And that's where I want this crystal clear comprehension of, can I put the wood physically on the ground? Can I margin this? What are some of the contingencies? If what I thought it doesn't work out, what am I going to do? And that's kind of the forward thinking, as far as this is still a valuable trade. Even those that are upside down on their futures, the reality is that if you sold November at $630 and November's meant to be at 730 or 750 or 770, if you have the ability to see the convergence through, again, you might not capture 100% of the basis at the day that you did the trade, but you're going to capture a large percent of it. You're going to capture 80 cents on the dollar, 70 cents on the dollar, 90 cents on the dollar. You just have to have the patience and the comprehension of why you did it.
All right. One other landmine and then a half a landmine I want to cover. We talked about the future side. Let's talk about the cash side, the physical wood sitting on the ground. Time is not always your friend in storing wood, because the wood can sometimes not look so good. So sometimes you may actually have to extend the trade by moving your futures contract into the next expiration. But in doing so, you're holding on to this cash. And while you're holding on to that cash wood, it has potential to degrade a bit. It costs money to store. There's definitely, a storage cost. So that's just something to think about. It's always, I like the opportunity, because I think it's a great way to have prompt wood on the ground that you could sell and replace and sell and replace. But that's a whole nother topic. But I think it's important to understand, along with having the liquidity to continually fund your futures account, you have to have the liquidity in your selling of that cash wood to be able to sell it, buy it back in, sell it, buy it back in, keep it fresh, basically.
Yeah, so and I agree. And that, like the example would be, are you really going to put wood on the ground if you're in the desert, if you're in Arizona, if you're in Phoenix in the middle of summer, where you don't have indoor storage, the wood's perishable, you've got heat, you've got humidity down south, like with southern yellow pine, where this becomes a better opportunity to start to store yellow pine because the humidity starts to diminish versus spring or summer. There's all these variables that need to be thought, well in advance of, and again, understand what you're trying to accomplish. The idea, well, this is a basis opportunity, the industry's doing it. That doesn't mean you can do it or you should be doing it. And that's where, you lay out both sides of the trade, the physical cash side, the future side. Do you understand both sides? And if the answer is yeah, and it makes sense, then you do it. If the answer is, well, I don't like the one side or I don't like the other side, then it's probably not an opportunity for you.
Exactly. So the last little landmine I want to bring up is tracking the trade. And you hear this all the time, where the inventory that was bought to hedge against the futures to create the basis trade, somehow that inventory gets spun, gets flipped, and you lose track of what the original cost was. And I think this comes back to, it takes a smarter than average person. It doesn't. It just takes someone who understands, especially in the accounting department, on how to track the trade. So those are the three landmines that I would say.
So Mike, I just want to add one thing on that. So there are four sides of the basis trade. There's the buying and selling of the physical cash. There's the buying and selling of the futures. And you have to have the ability, somebody financially has to have the wherewithal, the ability to marry the two sides of the trade. You've got the physical cash, you've got the futures. They might not be combined on the same financial statement, where you might liquidate the cash in one quarter, the futures might be liquidated in another quarter, but you still have to have the financial wherewithal to mesh the two trades together to get a true appreciation for, was this a successful trade? this is the net loss in cash or the net gain in cash. This is the net loss or gain in futures. You have to combine the two together to get a true representation of what the basis opportunity, did the basis trade work? You've got to marry both the futures and cash side of the transaction together. And that just comes down to record keeping and the ability to have somebody financially keep track of the trade.
Yeah. So what I want to have laid out is that this is simple math. You need to be organized. You need to be aware of the condition of your product. You need to be aware of your liquidity, cash position to fund that account. All of those scary landmines are way overshadowed by the opportunity. Like Ashley had put in the comments before, this is a $15,000 to potentially $20,000 trade. When you think about if you did it 10 times, that's a $200,000 winner in 2 months, 2 to 3 months, 4 months. This is an incredible opportunity. Here's what, let's wrap this up. If you have more questions, feel free to call me. Feel free to get in touch with Greg. But this basis trade opportunity right now is an amazing opportunity. I almost feel like it's the duty of our industry to engage in these trades to take care of this anomaly of basis. I think we will as an industry. I think we'll get this right-sided. But this is a great conversation. We can probably touch base on this in a couple of weeks to see how this works. Next week, we're going to talk about volatility and how it's measured and what it means for you. And we can start dabbling a little bit on options.
Yeah, that sounds great. I appreciate it, Mike. And this is something definitely, as you get into the back half of this month, as you get into the beginning of November, I think it's definitely worth, definitely to revisit these basis slides just to see where the market stands at that point.
Yep, for sure. Now, anyone who's listening, if you have questions or want us to cover another topic, you can let us know, email both Greg or myself. We'll cover any topic. For the record, I've been in futures trading for 22 years now, actually probably more like 25 years. So I've just about got it figured out, I think, maybe. Hey, Greg, how long you been doing futures?
Approximately the same amount of time, somewhere in that 22 to 25 year window. I've strictly done lumber since 1998. So yeah, it's been a long time, and I've seen markets 135 to 1700 and everything in between. I know just in the commentary, Ashley referenced EFPs, and again, that's something we can talk about down the road. But that's something that everybody can do. Again, it's just the education aspect of it, and down the road, I'm more than happy to talk about that as well.
I like it. Next week's volatility. In 2 weeks, we're doing EFPs. That's a phenomenal idea. Hey, this was fun. This is what Materials Exchange is all about, by the way. We want to bring transparency, education. We want to make you a better trader, a better buyer, a better seller. So if we can do that, we've won. Greg?
Yeah, no, I appreciate the opportunity, and I completely agree, Mike. Education wins. The more educated people become, the more it benefits them from a financial standpoint running a business.
Cool. All right, everybody, we're signing off. See you next week.
Thanks a lot.